Welcome to the Fine Print. I am today with Gaurav Mehta, who is fund manager at SBI Magnum SIF. Welcome, Gaurav.
Thanks, Neil. Thanks for having me, and a warm welcome to all the viewers.
Gaurav, you've launched the hybrid SIF first. If you can first tell us the positioning actually of this fund, where should it sit in the hierarchy of risk and return?
Right. So I think, when we launched this fund, what we did was a clear mapping of the risk-reward spectrums that different categories of mutual funds offer, and the idea was to bridge any gaps if there are. And one gap that we did identify was that people are obviously at all points trying to maximize between returns, stability of those returns, and tax efficiency. And to that extent, there is arbitrage, which gives you tax efficient, stable returns, although the absolute number may be low. And then there are these hybrid mutual funds that promise to offer you a bit higher returns, but they also carry a degree of variability in returns, and they are tax efficient. So, but this gap, not a lot of investors who are investing in arbitrage today can directly make a jump towards hybrid mutual funds and carry, let's say, a 50-60% equity risk. So our idea was to bridge this gap, and to that extent, this is a product that, from a potential point of view, can deliver higher returns than arbitrage, which will come with a degree of variability. But that variability is expected to be lower than what hybrid mutual funds typically offer, while maintaining the tax efficiency of equity taxation. So I think that's the broad positioning of this fund.
Right. So the closest hybrid fund category would be equity savings funds, but as we were discussing earlier, the volatility should be lower than ESF, equity savings funds, right?
That's right. So when you think of, and I can maybe talk about the product construct in detail a little later, but when you think of the overall construct, the idea is to have net equity exposure, which is somewhere close to equity savings funds. And I'm assuming here that equity savings funds typically carry about 35% of equity exposure. But with the use of options, the idea is to have a predefined risk level on all your positions, which may not be the case with equity savings funds because they're in a big vertical drop. There is unlimited risk with the equity exposure. So to that extent, on a day-to-day basis, this may look a little bit like an equity savings, and you're right in saying that. But when there are big falls in the market, this is expected to be less volatile, or rather more conservative versus even an equity savings category.
Okay. Now let's go through the construct. So you have 65% gross equity or more. And how does debt and REITs and InvITs sit at the gross level?
Right, so basically when you think of the hybrid long-short category, from a regulatory construct point of view, equity and debt are your primary asset classes, and you have to maintain minimum 25% in both. And beyond that, you're flexible to do whatever you want. What we wanted was the tax efficiency of equity funds, and to that extent, the asset allocation that we've chosen for this fund is 65 to 75% equity, 25 to 35 correspondingly then becomes your range on debt. And then we've also allowed ourselves up to 10% leeway to go into REITs and InvITs. So that's the broad asset allocation. But within which, when you think of equities, for example, 65 to 75% equities might sound a lot and may not sit with what we've been talking about with respect to the conservative positioning of the fund. And which is where the use of options comes in. And I think that's one big differentiating factor between SIFs and conventional mutual funds, that A, you have the ability to short up to 25%, which you can't do in a mutual fund. And B, the use of options is a lot more flexible versus mutual funds.
So, if I understand correctly, in standard long-only mutual funds, you can only use options up to 1/3 of the position in a stock, right?
Yes. So in a mutual fund, there are these covered call regulations where you write calls against your existing positions, which say that A, at the fund level, you can only write options on 15% of your total equity exposure.
1/5.
Yes, 15%. And at individual stock level, you can go only up to 30% of individual stock holding. And then the third restriction there is that you can only do it in Nifty stocks.
Sure.
None of these regulations or none of these restrictions
apply to
an SIF.
Okay. Sorry, so back to what you were saying about how that 65 to 75 gross comes down to 30 net.
Right, so what we do around all our positions is that, obviously we are dealing only in F&O universe because we need options to mitigate risk. What we use is what is popularly known as a variant of a collar strategy. Now, a collar strategy essentially means that against your stock holding, you have bought a put option to limit your downsides, and to fund the purchase of that put option, you've also sold an out of the money call option.
Correct.
So in a way, the payoff then gets limited to a range. You've sold a call at a certain point, so you don't make a lot of money beyond the point at which you've sold the call.
Yeah.
But you've also bought a put on the way down to protect yourself. And at the point till which you've bought the put, you lose some money, but beyond that, your losses also get protected. So in a way, it's like saying that I want downside protection, for which I'm happy to sacrifice some of my potential upsides as well. And then bring the total sort of allocation.
Put the stock into a range.
Yes.
And if the call premium exceeds the put premium, then you earn a positive spread.
Exactly. So, very conceptually and theoretically speaking, if you sell a call which is equidistant from the stock price versus the put that you're buying, so there, for example, the call is 3% away and the put is also 3% away on the way down, then the options premiums will broadly be similar.
Yeah.
And to that extent, you will be premium neutral.
Sure.
But if you structure it in a fashion that the call that you're selling is slightly closer and the put that you're buying is a bit further away,
Yes.
then the call premium will be higher than the put premium, and hence, because you're selling a call and buying a put, on a net basis, you can still expect to earn a net premium income. And in our case, that's exactly what we're trying to do, where we are saying that even when the market is sideways, you should earn some premium income, and hence the structure is such that on a net basis, you earn some premium income.
Sure. So therefore, the risks are more from the market falling than rising, right, in a sense?
Exactly. So, when you think of the position, right, you own the stock, you've capped your upside at a certain point, limited your downside beyond a certain point, but within this range, there is variation. And if the stock moves up within this range, it's net positive for the fund. If the stock moves down within this range, it's net negative for the fund.
Yeah.
So to that extent, you're right that a rising market is good. A falling market is relatively bad, although we've tried to mitigate the risk to some extent. A sideways market is neutral because in a sideways market, you're at least earning that premium income along with what your fixed income and other components of the portfolio are doing.
Correct.
And the essential thought here was that if you think of markets, they typically rise gradually in steps. So, if every month you're doing this strategy, you're earning some premium and participating in some upside, that leads to positive outcomes for a longish period of time. And when markets correct, they correct either through a sideways correction, as you've seen over the last 18 months, in which case you're mitigating that risk by earning that premium income. So that even in a sideways market, you earn something.
Sure.
Or they fall in vertical line over short periods of time.
Correct.
And in those short, big, swift down moves, if you limit your losses to a predefined extent, then you don't participate in the downside as much as you would in a conventional fund. And that is, in a way, a risk mitigant as well.
Yeah.
So I think that was the broad thought, how we thought, this structure would help us manage a sideways market, a downside market, while, obviously a rising market is the best case.
Of course. Now, Gaurav, the VIX also affects how much premium, as in the overall, how much are options factoring volatility, and the India VIX has not been very high, right? So, how do you see this? That do you need it to be higher for this to really optimize?
Right. So it's a tricky question. I mean, all things staying constant, you are absolutely right, which is that on a net basis we are earning premium. So higher the premium on options, the better it is. And if the VIX is high, premiums are high. It's a direct correlation, right? Because that's the pricing that decides option prices. But then the interesting piece is that the VIX will not move in isolation. It's also a function of how the underlying stock prices are behaving and how volatile they themselves are. So, to that extent, if VIX is very high, but your stock positions are also gyrating a lot, that will create a degree of volatility in the portfolio. Versus which, when VIX is low, but stock prices are stable and steadily rising, the price component will be positive for you. So it's a complex interplay between the return that you're generating from price moves versus the return that you're generating from options premium. But all things staying constant, as I said earlier, yes, because you're a net premium earner, a higher VIX level is positive because it helps you earn more premium for the month.
And just to clarify one point, even though you can, for example, go long a stock and short another, or put an option strategy on another, this is not what you're doing here. You're essentially buying or putting a collar around the same stock, right? You're not using the index as a proxy.
No, exactly. I mean, from what I understand, what you're saying is that what if you buy the stock and then use an option structure through Nifty options or some such thing, right?
Yeah.
I think the challenge there is that it opens you to a lot of spread risk, or the basis risk as they call it, right? Because we've seen days when, for example, yesterday, IT was down 7% at the index level or somewhere thereabouts. The index actually Nifty actually ended flat or maybe slightly positive.
So Nifty hedge would have been terrible.
Exactly. So if you owned only IT stocks and you hedged yourself through Nifty options, it wouldn't have worked. Actually, it would have killed you both ways.
Yeah.
Right. So which is why we are very clear that the stock has to be this options cover has to be on a one-on-one basis.
Yeah.
Where whatever stocks that you own, it's a direct call on that option and a direct put on that option.
Okay. So you use a strategy like we discussed earlier to bring down your unhedged from 65, 75 to 30.
Somewhere in the early 30s range.
In that range. Apart from this, you have some devices at your disposal, like only writing call options. Can you elaborate on right? So far, you haven't done much of that.
Right. So again, it goes down to the risk reward that you have proposition that you've chosen for your fund, right? If I'm only selling call options, I on a net basis earn a higher premium, right? Because I'm not funding any of it to purchase a put option. So on net basis, I earn a higher premium. So in a sideways market or a slightly rising market, it's actually a great outcome. You're earning more premium. But what happens if there's a sharp decline, right? So let's say a stock, for example, you sold a call 3% away, you earned a 2% premium. Till the stock is sideways, that 2% is an extra income for you. But what if the stock drops by 20%?
There's no.
You would have gotten a 2% offset from that premium, but you still lose 18% on a net basis in that position, right? And that's not the kind of risk reward that we were looking for in this fund. Our idea was that you should have predefined, in simple words, you should have a predefined stop loss level to each of your position thanks to the option structure. And correspondingly, that also means that you also have a predefined take profit level on the way up because of this option structure. Just to again, come back to that point on net equity exposure being in early 30s or somewhere thereabouts. The good part here is that while at inception that equity exposure reduces to half, if the stock keeps falling, then your put options become in the money, while your call options lose their delta because they become too far off, right? And if this put options delta starts approaching 1, which it will when stock falls a lot, then in a way your net delta on that position becomes 0. So that 30% exposure when there are big down moves actually falls quite drastically. So that you only participate in the down move till a certain point.
Okay.
And beyond that, the equity participation keeps dropping because your put options become more in the money.
But on that 30% you have not written, you're not bought puts, right?
No, so what I'm trying to say is that let's say if I have 65% gross equity exposure, on that entire 65% position, I would have sold calls and bought puts.
Okay.
The deltas work in such a fashion that let's say if I'm selling a call, it fetches me a negative 0.35 delta, and I buy a put, it fetches me a negative 0.15 delta. So in that sense, through this combination of selling a call and buying a put, I've gotten a negative half kind of a delta, which means that if the stock were to move either ways by 1%, I only participate to the extent of 0.5%.
I see.
Right? So it's not that we're leaving any part of the equity exposure uncovered. We're doing it on the entire portfolio.
I see.
But the way deltas work, that means that effectively on a normal day, the exposure reduces by half.
Understood.
But because of the non-linearity in options, as markets keep falling, your delta for the put option keeps increasing, but the overall portfolio delta keeps reducing such that your incremental participation in the markets in a down move keeps falling and falling.
Understood. Now, on the long side of it, do you also hope to earn alpha there by picking the right stocks?
Yeah. I mean, so as I said, right, I mean, all you're doing is you're making sure that whatever stocks you buy, there is a predefined collar around it so that your upsides and downsides are well defined. But within that band, if the stock does well, you make money. If the stock doesn't do well, you lose money.
Sure.
So to that extent, stock selection is extremely important. It's not a given that through this structure you will achieve a certain outcome, right? So our intent is also to focus a lot on picking the right stocks.
And that is fundamental driven.
So that's a combination. Fundamental is obviously the most important starting point because you don't want to buy businesses where you can lose a lot of capital, irrespective of you having a predefined range. The idea is to make money rather than lose, right? But beyond that fundamentals, we also bring in some tactical indicators into play. For example, we track positioning, right, in the stock, both from a ownership point of view as well as positioning in futures and options, because that also impacts short-term price moves. We would also track certain factors, for example, which stocks are exhibiting positive earnings upgrades, which stocks are exhibiting positive price momentum. And again, not all of these factors are equated or you're using all of them in the same proportions at all points in time, but these are factors that go into a decision making. Even things like results, expectation from the results, any fundamental trigger that's down the line, any technical events like index exits and entries. So that's the second layer where we are combining fundamentals with a bit of tactical overlay, because risk management is critical in this product. And the third piece that also comes into play at a later stage is also saying that how much premium are you earning on these stocks through the option structure. For example, if there are 3 stocks where we are equally convinced on the first 2 parameters that you ought to own them and they should do well. But of those 3, if I'm getting more premiums in 2, maybe my position sizing will change accordingly to reflect a higher position in the ones where I'm getting a higher premium versus the first one. So I think it's a combination of these 3 factors, fundamentals to begin with, a tactical overlay, and both these factors are focused on getting the price right. And the third piece is where I'm also thinking about options premiums and how much more premium can we get in these positions.
And how much of this is model driven versus human driven?
No, so we have created for ourselves a lot of screens which help in a quick decision making and in a framework driven way. But eventually deciding which stocks go in the portfolio is a subjective decision. So it's not based on any quant framework, or it's not algo driven, so to speak. That said, execution, a lot of it happens algorithmically.
And what kind of turnover do you have here?
So the options positions have to be rolled over every expiry, right? Because we're dealing in stock options largely, and stock options have a monthly expiry, and the liquidity is largely in front month. So every month you have to roll over those positions. On the underlying stock portfolio, the churn is not much, but versus a pure long only portfolio where it's only long term fundamentals that usually you use to decide on positioning, because you're using some tactical factors as well. So versus a long only fund, the churn can be slightly on the higher side, but it's not like we're churning 30-40% of the portfolio every month or so. It's much more contained than that.
South of 20% roughly?
I think so far I would think that the underlying cash portfolios would have churned by south of 20% every month for sure.
Okay. On the debt side, you don't take any risk, right? It's a standard.
Yeah. So I mean, because the overall positioning is conservative, and while there is some equity risk within that band, we thought that equities, are liquid assets. You can sell when you make a mistake. You can use options to hedge yourself and so on. Debt is a tricky animal, right? Where if you get it wrong, illiquidity might just kill you. So on debt, our approach is very conservative here, which means that typically we are looking at AAA or government bonds. There's a decent proportion of government bonds in the portfolio. So not going below AAA in terms of credit risk. And similarly, from an interest rate risk point of view, we are also thinking of usually papers which are 3 years or lower in terms of maturity, which in most cases would mean that the modified duration of the portfolio is less than 2 years.
Right.
So both on credit risk and on interest rate risk, lower levels. So in that sense, yes, it's a very conservative.
And that also acts as your margin?
Yes, exactly. So when you think of the options positions that I talked about, the good part is that they don't count in exposure calculations, because you're selling that call option against an existing stock position, and that's an offsetting transaction according to the regulation. But that call option short position will entail some bit of margin, and which is where this debt piece works as a margin, because those options positions can be funded through some instruments that work as cash collateral, and some other debt instruments that work as non-cash collateral, so that you don't have to put any hard cash. This entire debt piece, in fact, a portion of this debt piece is good enough to suffice for your margin requirements.
Yes. And the REITs and InvITs, you guys are not currently?
No, so we have up to 10% leeway to invest in REITs and InvITs. We have taken very selective exposure there so far, given the sharp run-up that you've seen over the last few months. But we are open to sort of exploring that stage. So.
And with REITs getting reclassified as equity, you may be able to go higher also.
Yeah, I mean, but so to the extent that this is structured as an equity taxation, we are taking the conservative view that that 65% has to come
Yeah.
from direct ownership of equities.
Yeah.
But within that 10% range that we've kept for REITs and InvITs,
Yeah. Yeah.
which will be over and above the 65,
Sure.
we are open to taking exposure.
Sure. And special situations?
So yeah, I think good point. Good that you brought this up. What we've also said is that the overall equity piece, which is 65 to 75%, can have up to 10% of special situations related trades. And to simplify things, special situations trades are usually some of these low risk opportunities that come up with certain events. And those events can be, an open offer. For example, Infosys did see an open offer a couple of months back. They can come through buybacks. They can come through merger arbitrages, right? Where you've a pre-announced merger ratio when stock A is merging with stock B, but because of holdings and liquidity and several other considerations, the stock prices may deviate from that merger ratio. So then, for you, the trade is to buy the one which is cheaper, short the one which is expensive versus the merger ratio, and play for that convergence.
Sure.
So some of these trades are part of that 10% bucket. Again, at all points you may not use the 10% window because these events may happen or they may not happen. They're very opportunistic in nature. But whenever they happen, you have up to 10% leeway available to take these exposures and add to a bit of returns. There's a very small allocation within this 10%, which will typically be 2-3% at any point in time, not more, where we can selectively do some good quality IPOs. But there again, our approach so far has been and will continue to be very conservative, where we are looking at well-established business models, where there is a listed peer set, and it so happens that sometimes companies coming up for IPOs, just because it's an IPO and they want to leave something on the table for investors, there is a valuation discount versus the listed peer set. So just playing that valuation discovery, and again the idea is to not carry that position as a positional exposure, get out once you get your liquidity window.
Correct.
But that again is a very small portion of the overall portfolio, and it's again not supposed to be positional long-term exposure. So in that sense, this entire 10% bucket is where you're expressing a view on a certain event, and most of it is extremely low risk in nature.
The absolute return so far has been around the 1.7% mark, right?
Yeah.
So annualizing that, I mean, a little south of 8% should be what should come. Of course, there are many risks and unknowns in all of this. Just want to quickly go through some of the hygiene factors in terms of redemption. So that's twice a week. The expense ratio is roughly how much?
Right. So first on the return piece, just to set the context here. Ever since we started, and bulk of our deployment would have happened around the October settlement date, derivative settlement. Markets have been negative. And in that context, till yesterday, I think we were at about 1.9% for the direct plan, which you're right would translate to a little less than 8% if you annualize it. But when you look at a normal market, you expect about 2.5 to 3% returns a quarter, assuming 11-12% returns a year, versus which this has been a quarter where you've actually seen a negative market. So to that extent, I wouldn't just extrapolate this number to guide towards a return number, but conceptually, the idea is to add about 2 to 3 percentage points versus an arbitrage fund. That's the intent. Let's see how it pans out. On your point on liquidity and exit loads, right? So, this is a SIF, right? So to that extent, there is daily NAV, daily subscription. The hybrid category of funds have been classified as interval funds by the regulator, which means every week there are 2 days where redemptions can happen. This is the regulatory construct, and we follow the same. On exit loads, there is some exit load within 30 days. I think it's 50 bips for the first 15 days, 25 bips for the remaining 15 days. But after 30 days, there is absolutely no exit load.
Right. And expense ratios?
Expense ratio, I think for the regular plan, if I remember the last number correctly, it's between 1.1% to 1.2%.
Okay.
So I think somewhere in the middle of that. And the idea was to keep expense ratios low because this is not an equity product where you're targeting 17-18% returns.
Great. I think anything else you'd like to add, Gaurav?
No, I think the idea is that SIFs is still in nascent stages in the country, and the fact that you can have propositions which are where you can short and you can use options means your ability to create returns which are relatively less dependent on the market direction that flexibility increases here versus a conventional mutual fund, which are largely driven by the underlying asset class doing well.
Yeah.
And which in a way, for asset managers, it allows them to create differentiated risk reward outcomes versus what you've seen so far in the conventional mutual funds. And that, in a way, I think should mean that investors will have a lot more options to fill any portfolio gaps there are in the portfolio. But I think, and good that you're doing this, it also means that investors, when they are seeing different risk reward products across different AMCs and within the same category also at points, their sort of hard work to do due diligence on the product increases.
Absolutely.
And I think shows like this will definitely help.
Thank you so much, Gaurav. It was a
My pleasure. Thanks for having me.